Good morning, good afternoon, or good evening, depending on your perspective on the world, and welcome to E-mini Think Tank's Ticked Off, using tick and share bar charts for more price detail. My name is Brandon Wendell. I'll be your guide and instructor for this little presentation. Been involved in the markets for well over 23 years, I guess, in professional capacity, working for hedge funds as a trader, working as a broker, trader as a broker, or trader for a brokerage, and a few other positions as well. And I've been teaching trading and investing for about, I think maybe 16, 17 years as well. So I got a little bit of experience in this and just wanted to kind of share with you a little bit of my knowledge to hopefully help you in your own journey in the financial field, in the financial markets. So, getting started here, I do need to put out a little disclaimer that I'm not a registered broker, dealer, or investment advisor. I may look at the markets, but I'm not giving you any recommendations of buying, selling, or holding any of the securities. And I'm not tailoring this towards any particular individual. There is always risk of loss whenever you get involved in the markets. You could lose money, period. And I'm not subject to any trading restrictions, so therefore I can hold positions in securities or initiate a position at any time. So just putting that out there. And we're going to jump right into it. So basically, charts are nothing more than a visual representation of trades that have been completed. So all the data points you see on a chart are records of completed transactions between a buyer and a seller. And when we're deciding what kind of chart to use, we can look to see what is going to give us the best amount of information in the shortest period of time and also in the cleanest and clearest way. So that's what we're looking at when it comes to charts. We really have three inputs when it comes to our chart. Number one would be time-based charts. So basically, these are set for a period of time to be noted on the chart, and when that certain amount of time passes by, you start to get new data points, or not necessarily new data points, but a new candle or new bar. I typically use candlestick charts as one of the more common ones, so that's what I'm going to focus on. So if it's a time-based chart and it's set right now on a 5-minute time frame, then every time 5 minutes goes by, you get a new candle. And another 5 minutes goes by, another new candle. And even if you have zero trades that occur during that time frame, you still have to put something there. So the program, your charting program, will usually just put a dashed line, a little dash. And it just lets you know that time has passed, but there were no trades during that period. Now, another type of chart that we're going to examine is called the trade-based chart, also known as a tick chart. So with a trade-based chart or tick chart, a new candle gets created only when a certain number of trades have been completed. So this has nothing to do with time whatsoever. It's not a factor. It's just whenever a certain number of trades have been completed, a new candle gets started and the old one gets closed off. And you can set whatever number you want for the number of trades or ticks. It's entirely up to you, as we're going to see. The last one we're going to look at is called volume-based candles or volume-based bar charts. And a new candle is created only when a certain number of only when a certain number of either shares, contracts, or lots have been traded. So it just depends on what it is you're looking at. If you're trading the stock market, it would be X number of shares. If it's the futures market, X number of contracts. Time is not a factor here either. Again, there's only new movement forward horizontally when enough contracts or enough shares have been traded. So we're going to dive into these three and see how we can use them to kind of better tune our technical analysis and get better opportunities. So there's not one that's necessarily best, okay? These are all different alternatives that you have available to you, and you simply need to choose what you like the best and what works best for you, what gives you the most information, the complete information, and makes you feel comfortable when it comes to your trading. So some people enjoy tick, some people enjoy time, some people enjoy volume, and they can all be right and very successful. So when it comes to chart input, again, when we're talking about time versus tick versus volume, this is a time and sales picture right here. And this happens to be from crude oil. It doesn't really matter. But there are three inputs that are being shown there. Number one is time. And again, when you have a time chart, as soon as the time clicks over, let's say it was a daily chart. Okay, it depends on the program, but typically at the end of the trading day, that would be the end of the candle, and then you would get a new candle beginning. If it was an hourly chart, every 60 minutes, as soon as that time goes through on this to the second, then you would finish off one candle and you get a new candle on your chart. So again, that's the time, the time-based charts are the ones that most everyone is very familiar with. They're the most common. You also have, as I mentioned, tick or trade-based charts. And every line here represents a trade. So whenever there's a new trade, that becomes reported onto your chart. And when there's a certain number of trades, depending on the settings you have, then you would get a new candle that you would close off the old candle. Finally, you'll notice not every trade has the same amount of volume. In this case, for crude oil, there's a trade down here for 5 contracts, another trade for 3 contracts, 2, 2, 2, 2, and the rest were all ones. So the other type of chart deals with that volume only, and once you aggregate enough volume, then you get a new candle. So it'll make a little bit more sense when we dive into the charts themselves. And your broker may have one or all or none. Well, not none. They have to have something. But they may have one or two of these and not all the styles. So, you just got to find the broker that's best for you and gives you the information and the tools that you need. So going into the common good old time charts, once again, it's your choice. Whatever time you want to use, time is fractal. So what works on larger time frames, the tools and techniques and the analysis that you do, it'll also work on the smaller time frames just as well. So when we're dealing with time-based charts, I happen to have this set right now for 15 minutes, and therefore each candle represents 15 minutes. What you'll notice about these charts at the bottom, the x-axis here, everything's pretty symmetrical. So it looks like it's every 3 hours, except for the last one. But for the most part, it's all symmetrical, pretty simple there. And when on this 15-minute chart, when the 15 minutes is up, you get a new candle. That's it. So the advantage is these are very common. People are very comfortable with them because they've seen them for quite a bit of time. And also the zones that are found there, if you're looking for where to buy and where to sell, if the zones are seen by a lot of people, then it's more likely to work because they will place orders that help hold certain price areas. So you have a little bit of extra power from the group all buying or selling in the same areas. The disadvantage to using time-based charts is you might not get as much information as you need. When you're looking at a zone where you want to buy or sell potentially, you don't know how much volume was there or how many trades were there or how many people were there buying or selling. So it could be interesting to see that information and know exactly how much momentum you have to tell whether or not a zone is going to work very well or if it's not. Additionally, when you use time-based charts, the zones tend to be a little wider. And typically, if you're buying on one side of the zone and exiting either for a gain or a loss on the opposite side, then you're going to have more risk. Okay? So that's what will happen is if you use time-based charts, you have a little bit larger risk. That's all. But it's not the end of the world, and we use these very commonly. So if we want to change and reduce our risk a little bit, one of the types of charts we can go into is called a tick chart. And I happen to be using Thinkorswim as one of my trading platforms here. So normally you would just go in and, again, I can look at crude oil on a 15-minute time frame. Every time 15 minutes is up, we will start a new candle. And if I were to go to a thinly traded security, let's say the 5-year Treasury, and maybe go down to a 1-minute time frame here. Let's see if I can find. Not really, but what I was trying to show you is that every minute there's a candle that has to be created. But if there's no trading going on during that particular time frame, what you'll end up getting is something like this. See where it's just a dash? That's a time-based chart. You have to have something there, but if there was absolutely no trades during that time frame, you got to just put a dash in there because price is never traded. But there's always got to be something there when it comes to those types of charts. Okay? So we can change this type of chart to a tick chart. And I'm going to go back to something a little bit heavier traded. Let's look at gold. So I go to gold, and instead of a time-based chart, I'm going to go to tick chart. And it's up to you what number of ticks you want to use. Okay, 512 is a popular one, so I'm going to go ahead and use that to start with at least. I'm going to clean up my chart so we can look at this fresh. There we go. And now what you'll see is a couple things. First of all, look at the bottom of my chart. It's no longer symmetrical. Right? You got this big gap between 1330 and 1345, then a small gap for the next 15 minutes to 2 o'clock, and then a small move over to 414, 430. So it's not symmetrical. You'll also see there's a countdown timer right there. That's counting the number of trades left until we get to the next candle. So I have this set right now for 512 ticks, or 512 trades. Every time there are 512 trades taken, I get a new candle. But we don't move on until that number of trades has been satisfied. Okay? So one of the nice things about this, and again, you can adjust these to whatever you want, but we can start to see a little bit more detail when it comes to the price action and what is moving price. So let me go back over here for a moment just to show you what I was going to talk about. Let's see. Oh, well, I already talked a little bit about this, where when it comes to the tick charts, we get a little more detail, and we can actually start to see momentum. And I'm going to show you how. The drawback of this is we don't necessarily know how many contracts were traded during that particular move. We know how many trades took place, but as you saw earlier, a trade could be 1 contract, 5 contracts, 30 contracts. We don't know. So that's the only disadvantage in using these charts is that you don't know exactly how much volume pushed price. You know how many trades pushed price, but that was it. And you may not have it available. Some platforms have it, some don't. But getting into the details that we're going to be looking for, let me just show you this. When reading the charts, it's no different than looking for buy zones and sell zones, or supply and demand, support, resistance, whatever you look for. It's no different. What we're going to be looking for is the origin of imbalance between buyers and sellers. That's usually where moves will originate. So if I can see a larger ranged candle, meaning not just the body, but the entire range between low and high of that candle, if it's very large compared to some of the others around it, that's indicating an imbalance. Because what you have to realize is every single one of these candles was created with the same number of trades. In this case, 512 trades. So if you have a small candle, there was enough opposing pressure nearby. There were enough buyers and enough sellers to just transact. They didn't have to go anywhere. However, if there's a larger range candle like this green one, it's not huge, but it is bigger than the other candles before it. So if there's a large candle or larger candle, it means that in order to satisfy all of the buy orders, in this case 512 buy orders, the buyers had to be aggressive and raise their price to attract sellers. There was a missing, basically there were missing sellers in that area. So there's an imbalance, and that can lead to telling us where the turning points are going to be in the future. And the same thing here, you have rally, base, 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 a little bit bigger of a move to the downside and continue down. Well, we got that move down kicked off because a little bit larger range, there were no buyers nearby. So in order for sellers to get their orders filled, they had to drop their price dramatically to attract buyers. And that shows us the origin of the imbalance. So unless something major changes, when we return back to that same area, there shouldn't be any buyers that miraculously showed up, and prices will reverse again. So going into our chart, live charts here, we can start looking, again, I'm on a 512 tick, and you just start at current price, look back, and I notice right here is a larger range candle. So this is telling me this area has a lack of selling pressure. There were a bunch of buyers who wanted to buy, again, 512 transactions, but in order to get those transactions completed, they had to raise their price they were willing to buy to attract sellers. So that tells me this may be an area that prices are likely to reverse if they were moving down because there are no more sellers in this area. Unless something fundamentally changes with the security, that is. Now, I use the same techniques for supply and demand to find these zones on tick charts as I do on my time-based charts. So this actually does not work as a zone for me because I don't have a clean leg in and base candle. It's a little bit off. But it's an area that I would keep in mind. If I'm happen to be short, I know that we could bounce a little bit here because we do have a lack of sellers to hold prices down, and prices may bounce. So looking a little further left and down, I'm noticing another area right here, larger green candle, right, and some follow through. Here we have this candle's a base, this candle's our leg in, so we actually have drop, base, and rally. So I would mark that off as my demand zone. And the reason why is we had a leg in, we based, and then once more, this is the important piece. The large range candle as we leave that area shows me there were no sellers nearby and the buyers had to be aggressive to attract any sellers. Well, unless something miraculously changed again on gold, when we come back to this area in the future, there's not likely to be sellers there again, and we should be able to bounce once more. So with these tick charts, you can adjust the sensitivity as well. You notice I'm looking at, well, with 512 ticks, a little over 3 hours, right? It's about 3 hours. You got 12:45 at the start and then 3:36 p.m. for the end. So if I decide I want to go a little bit more detail here, I want to be in and out of trades a little faster, you simply lower the number of ticks. That's all. So we can go down to, say, 50 might be too fast, but we could try it. And this would be what we call scalping, where you might find zones and be in and out of your positions within minutes. So if I zoom in a little more, again, same techniques work. If we were starting current price, looking left and up, we actually did drop from an area. We kind of overshot it a little bit, but you can see we had rally, 3 basing candles, and there's a drop down with a little bit bigger range. So sure enough, prices turned back down in that area. But that's no longer valid. So if I want to look for a fresh zone and try to trade this, I would keep looking back, and this looks really good right here. Okay, and notice what we have. Let me zoom in a little more. Clean this out. There we go. So the reason why I'm liking that area is prices were moving up. We had a basing candle right here where we basically closed. That candle closed inside the range of the preceding candle. And then once again, we started to move down with a larger range candle. There are no buyers in this area. If there were a lot of buyers in this area, we couldn't have moved down the way we did. So we have a lack of buyers and an abundance of sellers, or origin of imbalance. This is a good selling area if prices return back to it. Just above, looks like we might have had something there as well, but not really because we don't have a large candle leaving this area. Okay. So this is the best area that I'm seeing so far for selling and supply. If I want to look for where I should buy, looking left and down, my eye just gets drawn to the larger range candles. Now this has already been used, but it was a good area where there were no sellers. So, taking a look at that, you can see rally, base, and rally. So when prices came in, or were in that area, I should say. Let me fix this so you can see the wicks. There we go. So when prices were originally in this area, they left, but there was nobody willing to sell to these buyers that wanted to buy the contracts. So in order to attract a seller, the buyers had to raise their price dramatically, and that's what happened. So when prices came back down to that area again, just suppose we were watching this at the time. There we go. You would have seen prices coming back to the area right there, and that would have been a buy opportunity. And the reason why is when we were here before, we saw there were not a whole lot of sellers, and because the buyers were aggressive, they pushed prices very drastically to the upside. It's likely to happen again. So we buy with them, and prices went up. So you would have made a profit. Now, since that one has already been used, I just simply look back now for an area that has not been used. And if I need to, I can put in a price level. There we are. Extend that to the left and just keep looking back and below that line to find my zone. There we are. And it's unfortunate because we don't have good basing here, but we do have large candle here, large candle here. We might actually have the basing. Let's see. The close on this candle, 67.4. The low, yep, it's the same. So it is. We actually have a zone right there. Drop, base, and as you can see, that was the origin of good buying pressures. That may be where we bounce if prices come back to that area. Now, I got to be careful because it looks like we may have already used this. This might have been the origin of the move back here, but let's take a look. Let's see what happens. Here we are. Just trying to figure out what's happening now with current price. First of all, the nice thing about this is the zones are not huge, right? We're on a 50 tick chart, and what you can see with these two zones, this one on the bottom for demand is only 4 ticks wide. So your risk is very, very limited when it comes to gold, which is nice. And on the upside, it's only 6 ticks wide. So you reduced risk versus a time-based chart. Trying to think of what this might be comparable to on a time-based chart so we can take a look at the two. We could try maybe a 5-minute chart. Let me see. I'm going to keep this chart and open up one next to it. So once again, I'll just go GCJ21, and let's try that 5-minute time frame. Clean up the chart. There we go. Oops. That doesn't look like it's quite the same, so actually it might even be 3 minutes. Let's check that out. That looks a little bit more similar to what we were just looking at. Although, again, we're not seeing the same kind of detail that we were seeing in the tick chart, right? If I restore this down and go back here, this is taking me from basically 2:55 p.m. to current time, which is almost quarter to 4. And I'm seeing some levels that would have been able to be traded here. However, oops, I forgot I cleared out my zones, unfortunately. Here, nope, still not seeing it. So this is actually fine tuning the detail. Let's go down to a 1-minute chart. And again, now I can see on a 1-minute chart, that's pretty similar to what we were just looking at. So a 50 tick chart is similar to a 1-minute chart on gold. On different securities, it'll be different as well. But I'm just not seeing the same kind of zones here as I was seeing on the tick chart. Just don't get the same amount of detail. Sure, there might be a little drop, base, 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 and drop right there. And I can look left and down to see if there's some sort of a demand zone here. Don't have anything so far. So I'll have to go back even further. But as you can see, it's a little bit easier possibly and more detail when you're looking at the tick charts versus the share bar charts. So the next type of chart that we want to look at is volume or share-based charts. This is my personal favorite, to be honest with you. With the share bar chart, you get a new candle every time a certain number of contracts is traded. In this case, 1,000 shares or 1,000 contracts. I have this set on crude oil. So you'll notice once again, the time at the bottom is not symmetrical. Okay, it has nothing to do with time. So what it has to do with, and every new candle is only created when you have 1,000 contracts traded. That could take place with one transaction or 1,000 transactions. Doesn't matter. It's just the total number of contracts that must be traded before you move on. So with this, you definitely get a lot more detail, and you can see momentum that will help you with identifying whether a trend is going to continue or reverse. So if you see high volume or even lack of volume, that is equivalent to the momentum that drives price. The nice thing also is that when you take a look at these volume or share-based charts, there's usually a lot smaller zones compared to time charts. The disadvantage is, again, it may not be available on every platform. So you got to make sure you have that available to you, if you want to use it, that is. So it's not necessary. It's not like this is critical. You have to have it. But it is a nice tool that can help you with a little more detail about what's going on in price. So when we look at the charts, once more, we're going to be looking for those large range candles. Those large range candles indicate imbalance. And in this case, I think it's just a little bit better because you're now seeing in order to get 1,000 contracts traded, the only way you can get buyers to come in this case was by dropping the price dramatically. So if there are no buyers in this area, there's no way prices are going to go higher. As a matter of fact, because the sellers were aggressive, it was only one candle to get us to push down. There are a lot of sellers there. They may not have gotten all that they wanted to sell completed. So there's going to be leftover sell orders that will propel prices down once we return to that area. The same thing happens with the buy zones or demand zones. Again, we're looking for that origin of imbalance for moves where you had a lot of buyers but no sellers. So in order to get 1,000 contracts traded, the buyers had to raise their price they were willing to pay to attract those sellers. And it happens over and over again and can highlight where turning points are likely to occur. Now, when we look at these, we should really be looking at the zones, as I mentioned, the way that we normally do. So not just a large candle telling you where things are going to turn, but specifically a pattern. So I'm going to go out to a different platform here because I didn't have share bar volume charts on my one platform I was just looking at. This is NinjaTrader, which happens to have it. And I'm on crude oil. I've got it set to 1,000 volume, which again means anytime there are 1,000 contracts traded, we'll get a new candle. Notice the time at the bottom, not symmetrical whatsoever. And when we start looking back, all I need to look for is that large candle and then put it together to see, is there an area of supply or demand? So we start looking left and down. I'm not really seeing anything here as far as a good demand zone. So I'm going to put in a horizontal line. That way, as we look back, we know if we have to look below that line in order to find our demand. So I just keep looking back. And we might have had, well, it may have already been tested, but looking back right here, you see a little bit larger candles right there. And below that, we had drop, base. It's not quite as easy to draw with this platform than it was on the other. And then we had our rally right there. So we had not yet touched this area anyway, but the larger candle that took us up along with this one shows us there are not really any sellers in this area, just buying pressure. And the reason why I know that is because we had a larger candle. The buyers had to raise their bids dramatically in order to attract any sellers, so that way they could buy the contracts. That's it. And we can do the same thing if we're going to be looking for a supply zone, or I can keep looking back for more zones as well. But let's go all the way back to current price. There we are. And if I start looking left and up, yeah, there's a little bit larger candle right there. So there's definitely selling pressure in this area. But without a basing candle, I can't identify it as a supply zone. So I'll just keep looking back until I can find something. Once again, you can see lots of selling pressure here. And prices turned in that area. So if I had gone to a smaller size for volume, I might have been able to find a zone there. But not on this time frame. I got to find a specific pattern for my share bar. That was the title. That was the picture I took earlier. You can see that this was actually a zone. Rally, base, base, and drop. And that's where we turned earlier. So I just keep going until I find what I'm looking for, which is a zone. And unfortunately in this, I'm not going to find one anywhere nearby because prices have come from pretty far away. So let's switch securities. I'll go out to the Dow. And it's loading up right now. We'll start off with 1,000. The nice thing about this is we can also use these types of charts for swing trading or holding longer time frames. And the way you do that is just use it to higher number. That's all. So right now, looking at the Dow, I can see there's definitely some zones available nearby. Okay, when we look left, there's a red candle that's a little bit larger than all the other candles around it. Kind of stands out, right? Well, let's see. Do we have any kind of basing here? Not really. Nope. I take that back. We have a rally, base, base, drop. So this is a zone. I don't think it's a great zone. Okay. And the reason why, well, there's a smaller, I mean, it's a slightly larger red candle than the ones around it, plus you had fresh lows after, so there is follow through. If I had used the wicks rather than just the bodies of the candles, you can see prices did indeed turn around in that area. Now, where are they going to bounce from? If we continue to move down, we may see a bounce coming pretty soon because prices dropped, based, and again, we see not the big candle initially that we would like to see, but there is a little bit bigger range here than the ones before it, and then obviously a lot more buying pressure. As a matter of fact, we're also sitting at a level right now. So we may get a little bit of a bounce. Current price action. Let me show you. Rally. Red candle's the base. And then you got a green candle that rallied after. Right there. And because that's a little bit larger range, not as big as this one, but there's a little bit more of an imbalance, lots of buyers and not as many sellers. Look what's happening with price right now. It's pushing up. So if we retest this area, we may have taken out all the selling pressure. We could potentially go higher. Once again, my eye gets drawn to any candle that's a little bit larger than the ones around it. And we have, let's see, a leg up, base, 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 and then there's your drop with follow through. So this would be the zone right here. If we happen to break that prior zone that we just identified, this is where we're going next. Keep it simple and just follow the rules. In the E-mini Think Tank document section for our students, we actually have a list of how to find zones properly and what we're actually looking for. So you can go ahead, if you're a member, you can go ahead and review those and get a little bit more insight. It works the same on time-based charts as it does here on the tick and share bar charts. Now, as mentioned, you can use this for longer time frame trades as well. So if we decide, let's see, we want to do corn. ZC, let's see, we're in 0521. So I'll switch the security over, but instead of 1,000 volume, I'll go out to, we try 50,000. And I'm going to have to bring in some more days. So we'll do 30 days. There it goes, and it will load up now 30 days worth of price action. And let's see what it looks like. And it looks like we might want to add a little bit more data here as well. As you can see, we're going pretty big picture, but you get the idea. I could add a little more data. So instead of 30 days, maybe we do 90 days. And again, looking back, waiting for it to load. And here we are. Now we're looking at a lot more data, and this is going to make sense. So if you're looking at doing swing trading, you can still use the share bar charts and or tick charts as well. And like I said, the advantage is you're seeing the imbalance based on the volume, which is a lot more important than just looking at it through time. You can see there on the move down, there was a little bit larger candle here, then a pause and a continuation of a move down. We have rally, base, and drop there. So that could be identified as a possible selling area. The reason why is prices reversed, and not only did they reverse, but there were not a whole lot of buyers to hold prices up as prices started to fall down. Not the best zone, but it is something we can keep an eye out for. Additionally, looking left and down, you notice the big green candle there. That is going to be an area where there are lots of buyers but no sellers. Well, it's unfortunate because we did go below the basing candle, so I typically try not to use those zones, but there was obviously an imbalance there. And again, this is why I wouldn't use it, because I don't like on the move out, we should just go. By pulling back first, it showed that we took out a lot of the leftover orders, so I probably wouldn't use this area, but that's kind of what I would look for had that wick not been there. So once again, if I'm looking for swing trade on corn, we have our selling area. Oh, and that's why it won't work. It was actually a reaction to a prior area. A lot of times that happens. If I disqualify an area, really this was a reaction to drop, base, 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 and there's your rally. So you can see what a really good origin of imbalance looks like now. Okay, we had our legging candle with the red candle down. The basing candles that closed inside of it, And most importantly, the origin of imbalance is identified because the buyers had to be super aggressive. Look how aggressive they had to be and raise the prices dramatically just to get 50,000 contracts filled. So there's a high probability that there's going to be no sellers when we come back to that area. And because we left the area pretty quickly, there's likely to be leftover buy orders as well. And sure enough, there was. That was a buying opportunity. So that's kind of what we want to look for when it comes to these types of charts. As I mentioned, there are 3 different types of charts overall. We have time-based charts. We have, this comes with candles, that is. We have time-based charts for the inputs. We have tick charts, which are based on number of trades. And then as you're seeing here, we have share bar or volume charts based on the number of contracts or number of shares that are being traded in the security. It's entirely up to you which one you like the best and which one you want to use. If you'd like to learn more about this, I'd be more than happy to share more knowledge with you. You can find me in the E-mini think tank, and that's at wealthbuildershq.com. We meet on a regular basis 3 times a week where we look at markets live and apply all these techniques. And there's plenty of education mixed in with a lot of fun and charting and opportunities to see this stuff in use in the market. So thank you for your time. And if you got any questions, let me know. I'd love to see you again in the future. Take care, trade safe, and trade well.